Yeah, look, when you put it all together, and again, this is ex-Iran, and Iran adds a layer of complication onto this, which we'll talk about. But look, this has just been a really confusing economy. We cannot seem to get all the variables pointing in the same direction. Some of that is for economic reasons. Some of it is for policy reasons, right? There's a sense where if you look at the economy, which has performed relatively well despite this tension, in markets, we've always said the less they do in Washington, the better off we are. If we could have just kept Washington sort of out of the way the last couple of years, you feel like maybe we could have done even better. But because we haven't been able to, we've got these policy-induced shocks that we'll go through. And what you see is, okay, the labor market looks like it might be weakening. This is the unemployment rate going up potentially. Growth might be slowing, but inflation's going up. These aren't all supposed to be going in these different directions. And historically, they haven't been. It's just been a really unusual period. And that's just hard to navigate.
And just as this is inside of the Fed's SEP chart, and this is a measure of their take on certain of the risks inside of the Trinity. This idea that we haven't been able to catch a break. The last thing I'll just sort of add is we haven't been able to catch a break in many respects for about 6 years.
Yeah.
As we go through all of the things that have taken place. So there's a lot of waiting on Godot that we've sort of
look,
gone through.
It's a good point. When I say the last couple of years, that's a vague couple, right? I'm not making a political point. It's just been post-pandemic, or even during the pandemic and into and out of it, things have just moved in very unusual ways.
And these are it's a league of supervillains of inflation.
And this is the best example, right? It seems very long ago now. If you think back to prior to the pandemic, the concern that policymakers had was that inflation was too low. And in a lot of ways, the volatility was too low as a result. So, would that we were still living in those times. We haven't been able, again, to catch a break here. The pandemic pushed prices up, and just when it seemed like they were normalizing, the Russian invasion of Ukraine pushed prices up, and then it seemed like that was normalizing, and then we got tariffs. That pushed prices up. We're just now at the point where the tariffs are starting to fall out of the inflation series, and you would think that it should start to go down, but guess what? Now there's the war in Iran, and that's pushing prices up again. So it's this combination of different overlays, if you will, that are keeping prices elevated. And actually, if we as we progress forward, like under the surface, these shocks, or above the surface, I should say, these shocks just keep coming, and it just you can't get inflation to behave in the face of all these consistent shocks.
We've got a couple of things we're looking at here, and so once again, here's the timeline. We just showed it in chart form or in table form, but here on the left we've got these. Insert once in a generation event overlay, all of these. By the way, in terms of once in a generation, it's once in multiple generations. I've done the numbers on this. The average distance from the last time any of these major inflation shocks appeared to now is an average of about 82 years. So this is an incredible thing to see back to back to back to back to back. And now we've brought back the idea of geopolitics and the impact on oil, energy. I have semi-joked that I have this almost a tick that as soon as you talk about geopolitics, I will stay straight of Hormuz. It'll just come, rolling out. But we do have a couple of things here. One, taking oil prices at least with an inflation-adjusted view, and then, the supply side.
So look, we want to put it in context, and that's what the middle chart is trying to do here. In context, and the context is always hard to maintain when the news flow is the way that it is, the price of oil is up, but it isn't up to a disastrous sort of level. When we adjust it for inflation, all we're really trying to say here is relative to other things that people have to buy. Has it gotten more expensive? Yes. Has it gotten more expensive than it was historically? No. So yeah, the price of oil is high, the price of gas is high. Good news, bad news, the price of a lot of other things are also higher, right? So as a share of what people are buying, it hasn't necessarily gone up. That's important in that when we try to think about how disruptive this is going to be, how it disrupts households, how it disrupts businesses, it looks less disruptive than perhaps the headlines would make it appear. And I say that with some caution and a lot of humility. This is based on where prices are now, right? None of us sitting here today has the ability to predict where oil prices are going to go in the next few weeks or how long they're going to stay wherever it is that they go. So when we say it doesn't look like it's going to be all that disruptive, please add on to the end of that, as far as we know today, right? We don't want to get into the game of trying to predict the future. It could be disruptive. It's just that so far we don't think it is particularly so.
And onto this idea of the overlay. So since we're talking about inflation, let's talk about inflation ex Iran.
Yeah. So, and this is sort of what I was saying, above the surface with these overlays, things look elevated from an inflationary perspective. Below the surface, the picture isn't alarming. It does look like there's some good news. And please keep this in mind when tomorrow morning we get the CPI report in the US, and it's going to show headline inflation going up by about 1% in 1 month, which is a lot for any 1 month, because of oil prices. Look, away from oil prices, housing prices are gradually decelerating. Goods prices have started to come back off the boil as the tariff impact has worked its way through the system. And even non-housing services on the far right, which you can think of as sort of core inflation, like this is the key inflation metric that you want to be watching, is gradually working its way lower. So excluding the price shock, and I know that's a big thing to do, but excluding the price shock, we think the underlying inflationary picture looks okay. Doesn't look great. We're not all the way back to normal. It's not, flashing green lights, but it isn't flashing red lights either.
And in terms, the category of like really important things to watch, there are really two that we talk quite a bit about, and that's wages and tariffs.
Yeah, and consistent with that, right? On the left is wages. Wages are the key input for the services sector, which again is sort of the core of what this economy is these days. Wage growth is beating inflation, which is good for households, but it's not running away, which means that it's not driving inflation. During the pandemic, after the pandemic, wages spiked because of a shortfall of labor. That was one of the things that fed into inflation and why inflation ended up being less transitory than the Fed expected. It's good news that we aren't seeing those dynamics play out yet. Again, we'll continue to watch, but we don't expect to see wage growth accelerate in a way that would pull inflation higher. And similarly, the tariff impact, as we said on the prior chart, is starting to fade away. That's what drives goods inflation. And what you can see on the right is, in aggregate, okay, goods prices ticked up, but boy, again, this was nowhere near like what we saw during the supply chain disruptions following the pandemic. The tariffs mattered, but they weren't as pernicious as the supply chain shock post-pandemic.
All right, let's go to the second member of the Trinity, growth, something we said last quarter, the idea of solid but narrow.
Yeah, and I think that's still the right definition. On the left, you can just see the category breakdown, which fluctuates quarter to quarter. We put that there largely to illustrate that GDP on any one quarter is not a particularly reliable indicator of much of anything, because it gets swung around by trade, by inventories, and so on. But you can see that the average over the past few years is right around 2%, which is a reasonable number. But if you look on the right, what you see is this large gap in terms of how that economy is being perceived. The investor class, the people who have money in the market, look at things and say they're pretty good. Okay, prices are high, but the S&P equity markets, I'm picking that index because it's the broad one we talk about, but any measure of equity performance has gone up much more than inflation. So if you've been invested in the market, you're beating prices pretty comfortably. But if you aren't, if you're in the lower part of the K-shape, the black line here, households that are living more paycheck to paycheck, that don't have savings, that don't have investments, you don't have a cushion against those prices. And so their perception of the economy is much different than that of people who are wealthy. And the way we think about that is a narrow base for consumption. The bars on the left for personal consumption, the black-colored bars are the key to the economy. They are increasingly driven by just the top part of the K. Moody's Analytics has done some good work, and more than 50% of consumption is done by the top 10% of income earners in the economy. So no surprise that the perception is different depending on where you sit.
And a chart, part of the visual we showed last quarter on the business side too. So much of the spending coming from AI related. So it's concentrated and narrow on both sides of the equation.
If you want to oversimplify it, right, you would say that the economy is being driven by rich people consuming stuff and then companies building AI one way or another, building or buying it. That's an oversimplification and an exaggeration. But in terms of where the impetus for growth is coming from, it's probably also accurate.
Yes. Okay, so one thing I want to do now is make a little bit of distinction as we stay with growth is there's the difference between the rate of inflation and then affordability, the level of prices. So growth, of course, comes from what we buy. It's the expenditure method, and that relies on the consumptive power of folks. And so as we look at overlaying Iran and energy, particularly gasoline and that gas, which is always such a big part of the consumption for middle and lower earners on top of everything else, let's start to get into that overlay.
Yeah, well, go back again to this idea of the K-shape and where prices have gone up. We talked about inflation in the aggregate, and it includes everything from cell phones and computers to food and electricity. What you see on the left grid are things that we tend to think of as sort of core components that people more or less have to buy. You have to buy milk if you have kids. You have to keep your car running if you have a job. You have to eat. You have to have electricity. Those essential goods and services have seen their prices go up way more post-pandemic than they did pre-pandemic, and much more than the rest of the inflation basket. Right? In aggregate, inflation's running around 3%. Part of that is because the price of flat screen TVs keeps going down, or the price of cell phone data keeps going down, which is great, but it isn't cushioning households against the price of these essentials going up. And as you say, Rick, particularly for lower income households, these essentials take a larger share of their aggregate consumption. You have to spend a higher percentage of your income on food if you have a lower income, because everyone has to eat more or less the same, right? Now, if we posit that there's going to be a shock from the war, unfortunately, we would expect it to hit these essentials even more, right? It is gas, it is oil, it is energy, it is a large part of the supply chain for fertilizers comes out of the Middle East, goes through the Straits of Hormuz. And so if you're talking about food and agriculture, there's another vulnerability there. And again, we're not suggesting that we can tell you what that shock is going to look like, but if there is a shock, it probably makes things even worse for the bottom end of the K.
Yeah, you're thinking about obviously the price of gas, as you mentioned. It's also going to be everything that you're going to get shipped to you has to be on a boat, a train, a plane, automobile, whatever it is. And then, as you point out, then you start getting into the derivatives of petrochemicals and everything else. So the longer this sticks around, the longer it makes its way through it. Okay, so let's get to the third then. So let's talk about labor. And this is, in order to buy stuff, you have to have a job. So
the good news is so far people do, right? The rate of hiring has slowed, labor demand has slowed. Some part of that was government layoffs last year related to DOGE spending cuts and so on. But a large part of it was businesses just being much more cautious in the face of the tariff shock. And now in the face of AI adoption, where businesses, for the time being, appear more inclined to hire computers than people. We are in, the slide says it very well, an uncomfortable balance in the labor market where hiring isn't very strong, but neither is firing, right? Businesses aren't laying people off. They're just not hiring new ones. And you can look at the data in a couple of different ways to try to get a sense of the underlying dynamics. As our population ages, demand for healthcare workers is going up. That's been the primary driver. The middle chart shows you what it would look like if you take healthcare out of there. Look, healthcare jobs count too, so I don't know that you want to take it out, but it is a reflection, I think, of the generally lower demand for workers across the economy. The other thing on the right, and this is more of a technical note, the revisions to the labor data, because we get an initial release and then we get a revision, and then the next month we get another revision, have systematically been lower during this cycle. Part of that is just that the data have been more volatile, but part of that is that there is generally a trend. When the labor market is weaker, the revisions tend to be down. As it strengthens, it tends to go up. I don't think it changes the picture necessarily. It's just another bit of evidence that labor demand is pretty sluggish right now.
However, as the title suggests, an uncomfortable balance is still balanced.
It is still a balance. And I think the chart on the left is the best one we can show you to illustrate that. Right? And the left is the layoff rate, and it's not going anywhere. Businesses aren't laying off a large number of people, even as the hiring rate, which is in yellow, has plummeted. So, again, you're looking at businesses that are sort of frozen and the labor market that is sort of frozen in this uncomfortable balance where people who have jobs are largely keeping them, but businesses are not necessarily looking to employ new people.
And so with all this in mind, as we're looking at projections, this is the Fed's projections for our Trinity.
Yeah.
What are we thinking about what's priced in for rates?
I love these forecasts because, and every forecast does this, they always look much smoother than reality, right? It's a nice smooth line going sideways. We know that reality is going to be bumpy. So I don't think anyone should take these as precise, but in a general sense, what they reflect is a base case where the status quo largely prevails, where the labor market in the middle, we sort of plug along with unemployment around where it is now. It's 4.3, and that sort of moves sideways, and growth sort of stabilizes at around 2%, and inflation over time works its way back down to 2%, and everything kind of comes out perfect. And you know, look, that's the nature of the Fed's forecasts, because their forecasts are conditioned on optimal monetary policy, sort of by definition. If you've conducted optimal monetary policy, you end up with a good outcome. Trouble is, none of us know ex ante what optimal monetary policy is. And of course, that's even before you get into the shocks that we know are and will continue to buffet the system. This is your starting point, not your ending point. And the ending point will depend on how things play out.
And it's basically, this is the Fed saying something structurally hasn't broken.
Yeah.
And so as a result, we think that we're going to get back to what
we think we can get back home. Right.
Okay, so then let's stay with this idea of what's priced in. So the Fed, in terms of rate cuts, expectations, and ours.
So we generally agree with the Fed. Our base case is a relatively benign one, where growth sort of sticks around 2%, the labor market stabilizes, and over the next couple of years, inflation recovers from the shock of oil prices going up and starts to work its way gradually lower. In that world, we think that the Fed will be able to cut rates too. Our expectation is they'll cut rates a couple times between now and the end of 2027. I think it's reasonable to expect that those cuts, which we originally would have expected in the middle of 2026, may have been delayed by the war, because you need to see how that passes through the system. But the point we want to make with our forecast is that we generally agree with the Fed that the next move is more likely to be a cut than a hike. And we've put some quotes over there. The bar to a hike is pretty high. That's not something that's on the table for the Fed right now. It's not to say that it's impossible, but unless inflation expectations move, it's hard to foresee. In the meantime, there are a lot of circumstances where they could end up cutting rates. If the impact of the war ends up being greater on economic activity than it is on inflation, that would certainly lead them to a rate cut. If the labor market falls out of balance, that would lead them to a rate cut. So those paths are out there. And we still think, even as the market has moved to price hikes, that it's more likely that the Fed cuts than hikes over the forecast horizon.
All right, let's put this all together. Macro summaries, we usually bring it to a close.
There you go. It looks really perfect. 2% growth, 2% growth for the next couple of years. Inflation, acknowledging this year that it's going to go up as a result of the oil price shock, just based on where the forward curve is, but then starting to work its way back down. We've got a couple of rate cuts in there, and the 10-year rate is largely stable. It's trading, 4.25 today. So we think there's a little bit of room for it to come down. But in our base case, which is that the economy isn't disrupted by the war in Iran, you end up back on this path to a stable sort of equilibrium.
I think it's extraordinary with everything that's happened the last 6 years with those Richter scale events. And we sort of undulate through where we expect this will happen over the next couple of years. We get hit with another one, we think this like, it's extraordinary that we're still kind of, look, once everything clears the mechanism, these are exogenous. Once it clears the mechanism, if we stop getting things that keep showing up one after the other, once it clears the mechanism, the natural rate of growth in the economy, as we believe and the Fed believes, is around a deuce. The inflation rate is a 2-handle, and that results in the official rates and the long rates that you're going to see in the shape of the curve.
Well, and it just goes back to what we said earlier, right? And if we could just, you put it as if we could just avoid these shocks, if we just keep Washington out of the way. I should expand it and say the whole global policy, geopolitical environment, and if we could just get some stability, maybe we wouldn't have to leave this meeting every quarter with the macro section. I could shut up and you could listen to someone else.
Jokes aside, before COVID happened, the macro section used to be the small, it was tiny. There was nothing to see here. It was about trying to squeeze the tiniest bit that you could out of markets with elevated valuations or low real yields. Like, that was the story. By the way, trivia point, as Eric talks about low levels of inflation, in the 10 years before COVID hit, CPI averaged 1.8. That was the average CPI for the 10 years before we got into my so-called league of supervillains of inflation.